Good afternoon and welcome to GrainTV. It's April 2nd, 2014. To my left is Logan Burgess and I'm Schimbeno. A mostly negative day in Chicago. Let's turn over the quotes to see how we ended. Corn was down 11 1/4 cents. Soybeans on the old crop down 22 3/4. Wheat in Chicago down 16 3/4. Kansas City a slightly positive day, up 1 penny. You know, Logan, we did see a mostly negative day for corn, soybeans, and wheat.
Yep.
This is a little bit of a reversal of the fortune that we've seen to start off the week.
Yeah, you know, today if we take a look here at the old crop soybean contract, this is a daily chart here of the May contract. You can see that early in the trade session we continued to see strength, took a run at $15 a bushel. About mid-session though, tables really turned and we sold off hard into the close here. Right now on this old crop soybean market, it's hard to be overly bearish based on the numbers that we got on Monday from the USDA. But this market, like any market that we see, rally substantially. We need to keep an eye on demand and see when we start to see indications that demand side numbers may be being impacted by high prices. Take a look here at this chart. This shows the spot soybean crush margin in dollars per bushel. You can see that it's down sharply here in the last several sessions. And this chart basically details the revenue to a crushing facility for buying a bushel of soybeans, crushing it to produce soy meal and soy oil. The red line here around 50 cents per bushel is kind of used as the rule of thumb break even for many of these facilities. So obviously a crush margin below break even point isn't good for demand here moving forward. And this seems to be a situation that we're seeing in China right now as well. That could be influencing old crop sales that we've seen here in recent weeks. This slide here details the weekly pace of old crop soybean sales going to China. Now, seasonally, it's not unusual to see a decline following U.S. harvest. The one thing to take a note of, though, is the frequency of net cancellations we're seeing here. 4 out of the last 6 weeks, we've seen China be a net canceller of old crop U.S. beans. That could be one thing that's starting to weigh on the market. So considering this market right now, as I said, took a strong run at 15, turned sharply lower. Keep a close eye on things. If prices can take another run at 15, it may not be a bad time to look at sweeping out the bins for producers out there still holding on to the old crop. You know, Brock, let's take a look, though, at corn today. Based on the numbers we got on Monday, smaller acreage from the USDA, still relatively tight stocks. What's kind of your outlook on this corn market right now? Is it in the same boat or a little bit of a different situation than beans?
You know, I'm a little bit more bullish on the old crop corn scenario. Like you said, we did get tighter than anticipated stocks on Monday. We saw less anticipated acreage to be planted to corn this year. But if you take a look at where exports are for this marketing year, we're running about 255 million bushels ahead of pace to meet the USDA projections. The kind of shocking part, though, is that inspections, we're only running about 12 million bushels ahead. So we have a lot of grain that still needs to look at to leave this country. Take a look at this table here. You can see the total sales as a percentage of the anticipated sales by the USDA. We're at 97% already, so almost the full amount allotted to export sales has been reached. We still have about 5 months left in the marketing year there. Another shocking number on this table is that 19 million metric tons of corn still needs to leave this country. So about 47% of the sales that we have right now still need to leave the country. So what this really tells me is that we could be setting ourselves up for a bit of a rally between now and roughly July 1st. Yep. This grain needs to be pulled out of the farmers' hands, pulled out of the bins, make it to the export markets basically before the end of the marketing year. You know, given history, and take a look at the top 3 lines here, the 1996, 2008, 2012, you can see that we've had significant rallies in similar years. So I'm not saying that this is going to happen, but there's a pretty good chance that we could see something similar to this happen.
So on the international front, we know that that's been supported for corn. Domestically, what are we kind of looking at right now as far as corn demand moving forward?
You know, domestically, ethanol continues to be a driver of the prices here domestically and in general as far as demand is concerned. You know, this week was no exception. We saw 37,000 barrels of production added to the daily totals this week, up to 922,000 barrels per day. So another large figure there from the ethanol industry. And if you take a look at what is driving the ethanol industry right now is the margins. The margins have taken off substantially to the upside. We're sitting at over $5 a bushel on the crush margin for Iowa facilities, and that's the highest level we've seen since 2006. So this is going to continue to give ethanol crushers to run at a high rate and continue to buy up that corn and get it out of the farmers' hands.
Oh, thanks, Brock, for that little breakdown here on what we're looking at for corn. As we said today in the trade, a lot of weakness across corn, soybeans, and wheat. The big thing to keep an eye on tomorrow will be those export sales numbers. In general, traders are looking for a pretty light week in terms of export sales for corn, soybeans, and wheat. In particular, keep an eye on those soybean numbers. As we said, we're starting to see cancellations stack up here from the Chinese. We'll have to see if that is within tomorrow's report. We'll be tweeting about that report as it comes across the wires tomorrow morning, so look for that at GrainTV. Thanks a lot for joining us, though, here on a Wednesday. We'll see you tomorrow for the export sales report.